Welcome back to the deep dive. So today we are looking at something that honestly feels a bit like a real life contradiction, you know?
Yeah, it really is. It's probably one of the most fascinating disconnects in the energy market right now.
Exactly. So our mission today is to unpack this really surprising resurgence in the offshore drilling market. And we're going to do that by looking closely at one of its biggest players, which is Transocean, ticker symbol RIG.
Right. And it's a perfect case study because it forces you to take a hard look at, like, the mechanics of market valuation.
Oh, totally. Just to set the stage for you, I want you to imagine like a massive state-of-the-art fortress.
Yeah. But floating out in the middle of a brutal, freezing ocean.
Right. Getting battered by hurricane force winds, 50-foot waves, the whole deal. And inside that fortress, they are practically printing money. I mean, pulling in millions of dollars a week, guaranteed for years to come.
Which is wild when you think about it. On paper, this structure is an absolute gold mine.
But, and here's the crazy part, when you look at how the broader public values the company that owns it, they are treating it like, I don't know, a leaky rowboat taking on water.
Yeah, the public perception is just completely divorced from the fundamental business reality.
It is a profound contradiction because as of June 2026, Transocean is sitting on this massive $7.1 billion backlog of guaranteed work.
Right.
The cash flow generation is incredibly tangible.
Yeah.
Yet the stock is just trapped. It's hovering in this narrow channel between $5.59 and $6.17 a share.
I mean, you look at a company pulling in guaranteed billions, and it really begs the question, right? Is the market missing the boat, or do investors know something we don't? Is there some hidden catastrophe?
Let me push back on that right away, actually, because seeing a company with billions in guaranteed revenue trading at around $6, is it just that investors hate the sector?
Well, to reconcile those two things, we really have to examine what they're doing, like their aggressive buyout attempt, the crushing weight of their corporate debt.
The debt is huge, yeah.
It is. And also how this highly specialized fleet might have positioned them for, honestly, a massive multi-year run that the market is just largely ignoring.
Okay, so let's start with the fleet, because before we can understand why they have billions in guaranteed future revenue, we need to understand exactly what they are renting out to the oil industry.
Right. So the core of Transocean's business isn't just generic oil drilling. Their competitive moat is built entirely around an incredibly specialized fleet.
Like, how specialized are we talking?
Extremely. They own, or hold partial ownership in, 27 mobile offshore drilling units. But the critical distinction is the composition of that fleet. We're talking 20 ultra-deepwater floaters and 7 harsh environment floaters.
Calling them harsh environment floaters almost like undersells the engineering, doesn't it?
Oh, completely.
I mean, we are talking about extreme maritime real estate here. This isn't a rig just sitting in 50 feet of calm water in the Gulf of Mexico.
No, not at all. These are vessels operating miles above the ocean floor. They're dynamically positioning themselves using these massive thrusters and GPS just to stay perfectly stationary over a wellhead.
While, like, ocean swells and gale force winds are actively trying to push them off course.
Exactly. And that specific asset mix dictates their immense pricing power. The technical barrier to entry there is just astronomical.
So a cheaper, lower-spec competitor literally just cannot bid on these contracts.
They physically can't. They lack the stabilization systems, the blowout preventers rated for those immense pressures.
The safety certifications.
Right. So when an energy major, like a Chevron or an ExxonMobil, needs to drill in these technically brutal, ultra-deep water sectors, their options are severely limited.
It's essentially a monopoly on surviving the harshest environments on Earth.
That's a great way to put it.
Yeah.
Transocean holds the highest specification floating offshore drilling fleet globally. So as the easy, shallow water reserves deplete, the industry has to push further offshore.
And Transocean becomes one of the only viable partners who can actually execute the work.
Right, which translates into an absolute stranglehold on pricing. Because they are one of the few who can safely operate out there, the cash influx is surging right now.
Let's talk about that cash, because looking at their first quarter of 2026, the turnaround is just stark. I mean, they posted $1.081 billion in revenue for that single quarter.
Yeah, and pulled in an adjusted EBITDA of $440 million.
Which is massive.
It is. That kind of margin proves just how lucrative this highly specialized fleet is once the steel is actually in the water and the rig is fully operational.
Right, because the operational leverage is huge. Once the fixed costs of crewing and maintaining the rig are covered, a massive chunk of every additional dollar falls straight to the bottom line.
Exactly. And the main metric driving that revenue acceleration is the day rate.
Let's explain day rates really quickly for anyone who isn't familiar. This is basically just the daily rental fee the oil company pays to use the rig, right?
Yeah, basically. And Transocean recently added over $1.6 billion in new backlog. The average day rate for those newly secured contracts is sitting at approximately $410,000 per day.
Wow. Wait, $410,000 every single day.
Every single day. And if you factor in the entirety of their $7.1 billion backlog,
Yeah.
it actually carries an implied average day rate of over $450,000.
Okay, I just have to do the math out loud here because that is an almost incomprehensible rental fee. At $450,000 a day, you are looking at over $3 million a week in rental fees for a single asset.
Yeah, it is an extraordinary figure.
But let me ask you, looking at the cyclical nature of energy markets, are these sky-high rates sustainable, or is this just a temporary spike in a tightening market?
Well, the underlying mechanics point to a structural supply deficit. You have to look back to the oil crash of 2014.
Right.
Following that and the subsequent decade of underinvestment, the offshore drilling industry really hollowed out. Operators just scrapped older, less efficient rigs rather than pay to maintain them.
And more importantly, the shipyards just stopped building new ones, right?
Exactly. Constructing an ultra-deepwater drill ship requires over $1 billion in capital, plus a 5 to 7 year lead time. And in an era where capital markets were pretty hostile to fossil fuel megaprojects, new builds just dropped to zero.
So now, as offshore demand rebounds, all these energy majors are competing for a stagnant pool of high-spec rigs.
Yeah, and you can't rapidly scale supply to meet that demand. There is no quick fix when you need a billion-dollar vessel that takes half a decade to weld together.
Which explains the recent contract awards. Like, on June 16th, 2026, Transocean announced $185 million in new firm contract backlog for the Transocean Norge and the Transocean Equinox.
Right, energy majors are aggressively locking in those high day rates right now. They're just absorbing the cost simply to guarantee they actually have the physical equipment necessary to meet their production timelines down the road.
It's basically panic buying by the operators.
Yeah, and the result is tangible financial momentum for Transocean. You can see it in the $136 million in free cash flow they generated in just the first quarter of this year.
Okay, so with $136 million in free cash flow hitting the books in a single quarter, what are they doing with the money?
Well, they're trying to get even bigger by eating a competitor.
The Valaris acquisition.
Exactly. Transocean is pushing for a mega merger. They've proposed an all-stock buyout of Valaris Limited.
Which, if successful, fundamentally alters the entire offshore landscape. I mean, it adds nearly $4.9 billion to their existing backlog.
Right. It would create an absolute titan in the space. The combined entity would have a level of contracted revenue visibility and asset density that basically no competitor could match.
Plus, it allows them to optimize where the rigs are deployed globally and, strip out redundant corporate overhead.
Yeah, but there is a major roadblock here.
The regulatory cloud.
Right. The Department of Justice issued a second request, which effectively freezes the regulatory clearance process.
Now, wait. Usually when you hear DOJ's second request, antitrust regulators are deeply concerned about market concentration, right? Like, they might be preparing to block the transaction entirely to prevent a monopoly.
Yeah, that's the standard worry.
So why isn't the market panicking? A DOJ block usually sends investors running for the hills.
Well, the regulatory scrutiny is expected. I mean, you have two of the largest players in a highly specialized, capital-intensive industry attempting to merge. Regulators obviously want to ensure the combined fleet won't give Transocean unchecked power to extort energy producers.
Sure, that makes sense.
But the financial markets are telling a very specific story about the likelihood of this deal surviving. Institutional investors focus heavily on the merger spread.
And the merger spread here is surprisingly narrow, isn't it?
Very narrow. If Wall Street actually believed the DOJ was going to block this, that gap between the target stock price and the acquisition price would be massive. Arbitrageurs would price in the collapse of the deal.
So the fact that it's narrow means institutional money is clearly betting this goes through.
Exactly. The smart money views this second request as a bureaucratic timing delay, not a deal breaker. They expect the merger to close. They just acknowledge the timeline has shifted a bit.
Okay, so let's summarize where we are. We had a fiercely protected competitive moat. We have sky-high day rates locked in by desperate energy majors.
Yep.
We have robust free cash flow and a pending merger poised to create an absolute industry behemoth. And despite all of that, the stock is languishing at $6.
It's a total disconnect.
It's like, I don't know, owning a sports team with a flawless statistical record, but they just have terrible PR. The market isn't looking at the fundamental reality at all.
Well, the sentiment is definitely mixed. Automated feeds rate the news flow around Transocean as strictly neutral.
And Jim Cramer recently waved off the stock entirely in early June, right?
Yeah, he advised investors to just deploy capital elsewhere. So there is this pervasive institutional reluctance to embrace the narrative.
Even internally, the insiders aren't exactly pounding the table. If you look at the insider trading data, insiders sold about $0.6 million worth of shares over the last 3 months.
Right. Which, to be fair, in the grand scheme of a multi-billion-dollar enterprise, $600,000 is a rounding error.
Yeah, it's not a panic dump. Executives have tax liabilities and, personal expenses.
Sure, the selling is marginal. But the absence of aggressive insider buying is the really critical takeaway here.
Because if management believed $6 was an irrational mispricing, they'd be buying it up.
Exactly. You would expect to see them systematically accumulating shares. The lack of buying pressure from the people with the deepest visibility into the company reinforces that neutral stance.
Which brings us to the real reason the market is ignoring the $7.1 billion backlog. It's buried on the balance sheet.
The dead anchor.
The dead anchor.
Yeah.
We have to look at the worst case scenario here, the bear case, because Transocean is a highly leveraged company.
Yeah, they survived the brutal, decade-long offshore depression, but they financed that survival with a massive mountain of borrowed capital.
So that $136 million in first quarter free cash flow, that isn't just a bonus that can be casually distributed to shareholders via dividends, right?
No, not at all. It is absolutely critical for paying down their massive debt load. In a highly leveraged company, the debt holders dictate the terms of survival. The interest payments are fixed, mandatory obligations.
So let me challenge the entire bullish narrative here then. Aren't shareholders basically at the bottom of the food chain in this scenario?
Yeah, you're at the very bottom of the capital stack.
Isn't Transocean essentially just working for its creditors right now? Meaning any hiccup in revenue could completely wipe out the equity.
That is the exact execution risk. The senior bondholders have a secured claim on those cash flows. If a major macroeconomic shock hits and those $450,000 day rates compress.
Or if a critical rig suffers a mechanical failure and goes offline for 6 months.
Right. The revenue plummets, but the interest expense remains rigid. So in a severe downside scenario, the equity holders are the ones absorbing the entirety of the shock.
And that danger is just compounded by the Valaris merger, isn't it? Like, if the DOJ actually blocks the deal, they lose out on $4.9 billion in backlog.
Yep, and they lose the crucial operational synergies that would have accelerated their debt reduction strategy.
Yeah.
The current $6 valuation is basically the market demanding proof.
They want to see Transocean actually de-lever the balance sheet before they assign a higher multiple to the stock.
Precisely. They want them to navigate the regulatory hurdles and successfully use that contracted revenue to pay down the debt.
Okay, so weighing the incredible cash-generating power of these rigs against the heavy anchor of corporate debt, it really brings us to the final assessment for anyone looking at this stock.
Right. And looking at the analyst synthesis, Transocean earns a bullish score of 7 out of 10.
Okay, a 7 out of 10.
Yeah, analysts are looking at a probability-weighted value estimate of $6.81, which implies roughly a 10.3% upside from its mid-June levels.
But the timeline here is critical. This isn't a quick flip.
No, definitely not. This is a multi-year hold, realistically in the 12 to 24-month range, realizing that upside requires extreme patience.
Because it's completely reliant on management systematically paying down the debt, successfully closing that Valaris transaction, and basically flawlessly riding out the high day rates contracted for 2027 and 2028.
Exactly. You are betting that they can run these complex floaters without costly downtime and funnel that cash directly into balance sheet repair.
But if they achieve that,
Then the narrative flips completely. The sheer volume of free cash flow generated by those day rates will finally flow unencumbered to the shareholders.
which leaves you with a final, honestly fascinating paradox to ponder on your own. We are living in a world right now that is completely obsessed with the green energy transition, right?
Oh yeah, capital's rotating into renewables, AI, tech stocks.
Exactly. But beneath that headline, the physical reality is that the global economy still demands massive, uninterrupted oil production.
It does.
So, could the broader market be systematically ignoring the last great cash cycle of these high-spec fossil fuel giants? It's creating what could be a rare mispricing opportunity simply because the industry is seen as uncool.
It's a really compelling thought. Are investors willingly leaving billions of dollars on the table because of a narrative?
Right. It is definitely something to chew on. Thanks for joining us on this deep dive, and we'll catch you next time.